Hey everyone, Dan here. Today I wanted to take a look at the MACD indicator and sort of explain how it works and how it might help you in your trading strategies. As always, if you enjoy these videos, please hit the like and subscribe button. It helps a lot. I would say that's a small percentage of folks who watch these videos are subscribed. YouTube provides that data to us, so I know that it must be true. Just to say that if you have frequently watched these videos, please just hit that subscribe button and you'll get automatically notified, and it helps the channel a lot. Also, if you have a Reddit or a Twitter or a Facebook and you share stock things there, please feel free to snatch any of these videos up and share it on those sites as well. Okay, so MACD, if you're not familiar, is basically an indicator that will show you where the momentum is for any given stock. And so we can unpack that a little bit, but some things that this is going to help you with is it's going to help you understand when a stock price that's making lower lows might actually be turning bullish, so a trend reversal. Also, when a stock price is making higher highs, where it might be turning bearish so that you can take your profit. So lower lows but going to turn bullish gives you an opportunity to jump in and take an entry. Higher highs but turning bearish gives you an opportunity to lock in your profit and sort of like not get stuck holding the bag as the price sells off. So those are the big things with MACD. Also, sort of like in a longer term position, it can kind of give you an indication whether there is some bullish momentum in the stock and whether that bullish momentum is building or fading. And then same thing with the bearish momentum. Is the bearish momentum building or fading? So that might give you an idea, like if you are prone to panic selling, or if you're prone to just timing your buys very poorly, that could help you. So if you're selling out when there is bearish momentum and that bearish momentum is growing, then you're probably not panic selling. You're just selling out before it gets even worse. If you're buying in when there's bullish momentum and it's growing, then you're not likely buying at the top, and you're not likely making a poor decision and sort of like chasing an entry point into a stock. So those are the benefits of the MACD. And so if you look toward the bottom of the screen here, where I'm drawing a big circle, you'll see the MACD indicator. And let me just sort of unpack what you're looking at. So the yellow line, or the orange line, whatever it is the MACD line, and the blue line is the signal line. Okay, so those are your two lines. We'll call it yellow for this video, and blue, MACD and signal. And then you see these green, we'll call them hills, and red valleys. That is an oscillator. And the flat point, like where you see right here, so this flat line is called the baseline. The baseline is 0. Anything below the baseline is negative. Anything above the baseline is positive. And so as you see anything above the baseline being formed, that's going to be indicated by green, because that's going to be saying that there's bullish momentum. And if you see anything in red, that will always be below the baseline, indicating that there is bearish momentum in the stock price at that time. So here's a couple of ways to use the MACD. A very simple way is to just pay attention to the yellow and the blue lines and use them as buy and sell signals. So one way that folks use them is when the yellow line crosses over the blue line, they take that as a buy signal. So let me find, it's a little bit hard to see. Let me see if my screen is just dimmed. But if you look here, for instance, it's a little bit hard to see because it's caught in that, like, with the green hill in the background. But right here, the yellow crossed over the blue, and that means that there is growing bullish sentiment in the stock when it crosses over it going up. All right, and so if you had used that signal to buy in, you could have rode the price all the way up And then your sell signal is when the yellow line crosses below the blue. Okay, so you could have sold out here. So let's take a look at what that would have looked like in the price action. So right here, let me do my rectangles. Right here, the yellow crossed over the blue. We're actually during trading hours, so it's moving on me a little bit. So it's a little bit tricky. But there you would have bought in, and then you would have sold about here. All right. So we don't have to keep these here for very long, so we don't have to fiddle with them too much. But you would have bought in at about 122.29 at about 10 a.m. And then you would have sold out at about 122.79 about 15 minutes later. So you'd have had from about 30 to 80. So you'd have about 50 cents a share over the course of just 15 minutes. So that's probably a really good return on an options trade, for example. If you have a larger account and you're able to do hefty amounts of shares, that would have been a good dollar amount for several shares. That would have just been a good percentage increase for a short period of time in any case, just by doing a simple, crossover indicator strategy. So simple as that. When the yellow crosses from underneath the blue to over the blue, take that as your buy signal. When it then crosses below the blue from above, that's your sell signal. Now, one thing to look at is you can definitely get faked out. So if you look at this area here, so if you had taken this time to buy in here, you would have essentially gotten caught right here. And then you would have sold out and been like, what just happened in my world? Right here. So you would have still made a slight profit, actually, but it would be very slight. So we're talking about 122.23. So we're talking like 7 cents, 8 cents a share over the course of, again, like 15 minutes. So what you want to be careful of is also how steep the crossover is. So here you see this crossover took off and became very steep. And then when it peaked and started to come down, it started to come down pretty steep as well. So once you get used to the MACD, you can account for not only how, you can account not only for the crossover, but how smooth, aka flat, or how steep the crossover is. And the steeper the crossover, the more likely it is that you're about to get a big pump or a big drop. And the smoother that it is, the more likely that you're either going to get a small movement in either direction, and that you're going to get into this smoothing out over a period of time where it's just kind of going above and below, above and below, above and below, and nothing super impactful is happening. There's just kind of bobbing and weaving. So what you want is a situation like this. What is just kind of like eating up your time, to be honest, is situations like this where it's just over and above and over and above. That is if you're just using the two lines as signals. So let's talk about some sort of like additional strategies that you can use to enhance the MACD reading. So if you see this green line here and this red line here, I can explain to you what those are. So in this situation, you would have seen TSM making lower lows. And if you were just watching that, you would have said, okay, this is making lower lows and it's forming a downtrend, and this isn't either I'm going to take a short position here, or this isn't worth me trying to play in any bullish scenario. But if you take into account the MACD, this is actually what's called a bullish divergence. And what that means is you see the stock making lower lows. At the same time, if you look at the yellow line here, you see how it's making a low, and then it's making a slightly higher low, and then it's making a much higher low, it's making an even higher low here. That was a high, a higher low here. So you have low, slightly higher low, definitely higher low. So that is happening while the price itself is making low, lower low, lower low. So that's the divergence, that the price is making lower lows while the MACD, the MACD line, like literally that yellow line, is making higher lows. And what that signals, why it's called a bullish divergence, is because that's saying, yes, the price is making lower lows, but there's actually buying pressure, buying momentum coming in to the stock at this time. So while it's dropping, buying pressure is increasing. And that should say to you, I should think about taking a position as a dip buy opportunity when I see this bullish divergence. And as we see, had you bought in at that bullish divergence, you could have rode the price strength from 122.20 up to about 122.64, and made that profit over the course of a little over an hour. You would have caught this entire leg up here. So let me talk about the bearish divergence, because there's a bullish divergence when a downtrend is about to turn bullish, but there's also a bearish divergence where an uptrend is about to turn bearish. So the bearish divergence is exactly the opposite. You see this high, and then you see this is a higher high, but you see this high is a higher high than this one. So we have high, lower high on the MACD, and then we have high, higher high on the price action. And as you see, like, these are very slight. These aren't steep, but that's okay. It still stands. It still stands as long as it is a higher high. It doesn't have to be X amount higher or X amount lower over here. It's just if the lows are lower, if the highs are higher, and if the inverse is true on the MACD, then it's called a divergence, and you should be looking for an opportunity to either take a dip buy on the trend reversal or take your profit, lock in your profit on a trend reversal there. Okay? So as this is playing out in real time, also you're seeing maybe a crossover here on the yellow about to cross over the blue. So we'll see. But it's been kind of waffling back and forth. So we'd want a steep one. We want to see a steep uptick here if we're going to snatch anything good. So that's what you look for in the bullish and the bearish divergences. Now, if you're looking a little bit longer term, say you want to try to figure out from this point today when it pumped up, where is the momentum? Is there any sort of like distinct momentum happening? That's where you can use the oscillator, the green and the red, the ones that are green above the baseline and red below the baseline, to figure out sort of like where there is any kind of momentum happening. So if you look at this green hill and you draw a line to the next green hill and to the next green hill, so on and so forth, that is waning, right? That is decreasing. Those hills are getting smaller and shorter. And then on the red side, let's say you wanted to see from this dip, the red side, these are, it came up and then it sort of like came back down a little bit, but it's mostly staying flat, right? It's pretty flat after this dip. So everything is essentially consolidating at this moment, which could mean that it's consolidating and preparing for another big push. Now, we don't know which way it's going to push. If it crosses over steeply, the yellow over the blue, then we're going to sort of take that as a signal that we may want to take a bullish position, because again, you just go with the information that you have, and more time than not, you want it to be right. Sometimes it will be wrong. But that's what we're going to be looking for when something does this thing where everything is just kind of flattening out toward each other, and neither the bullish, aka green, or the bearish, aka red, are increasing in strength. That's called consolidating or coiling, and that gives you an opportunity to keep an eye for the next big push. But just remember that next big push could be bullish or it could be bearish. That's where you want to read your signals here. You want to look up here to see if there's any divergence, right? So right now, you see there is some lower lows forming. So if we were to see some higher lows forming on the MACD here, that would give us an opportunity to say, there might be a bullish divergence happening here. And that gives you additional information to go off. So there's the crossover where the yellow crosses over the blue, and then there's the bullish and bearish divergence. So those two things together give you strong indications of what's happening. And then there's the overall momentum of the green hills and the red valleys, and if those are gaining strength or losing strength. That gives you a good sense of like the overall sentiment in the buying pressure or the selling pressure of that stock. So you can do this definitely in longer time frames as well. Let me see, we're on TSM. On the daily, I have this channel, this long-standing channel that I've been playing, that this has been in, as when it was in the 40s, and it's 120 something bucks right now. So this dates back way to February 2020. So over a year, the stock has been in this channel, and now it's toward the bottom of the channel. But you see how the MACD adjusted when I adjusted out to the daily time frame? It adjusts itself as well. So it says, based on the time frame that you're looking at, here's what's happening. And so you'll see, there was about, what is that? The 31st of March, so about a week ago, there was a crossover. So the yellow crossed over the blue, giving us some upward momentum. So you can adjust it for any time frame and kind of read the same things. You can see here, actually, let's see if I can draw this in. So here, see this high to this high? Turn this that color. And you see this high and this high? So the corresponding highs on the MACD with the corresponding highs on the price action. This high and this high was higher. This high and this high was lower. That's a divergence. And which divergence is that? That is a bearish divergence. And what happened after that? The yellow crossed over the blue, and we got a pretty steep sell-off from about 142 down to 108. So yeah, pretty big sell-off after that bearish divergence. But as you have these divergences on something like the daily, because that's accounting for so much more time and so much more price activity, you are much more likely to get those big changes, like sort of more true trend reversals in the overall scheme of the stock versus the minute by minute, which is what we're looking at first, where you're looking at, yes, it's going to change the trend or the direction, but it still is going to be probably just over the course of a few minutes, meaning something less than an hour probably, because you're looking at a 1 minute chart. It's built for intraday activity, and so it's probably not something that you're going to identify and then ride it into tomorrow and into the next day and that sort of thing. So adjust your time frames accordingly. If you're trading intraday, 1 minute, maybe 5 minutes. If you're trading, daily or every couple of days, maybe 30 minutes or an hour. Definitely weekly, like a longer term swing trader, I'd go hour, 2 hours daily, something like that. And then for your longer term stuff, you can certainly go on the weekly chart, but that's pretty tangential from this. but anyway, that's just to say there's a bearish divergence there that you could have noticed. I'm trying to see. So we have definitely, we have a low and then a higher low, and you have the same thing on the MACD. So no divergence on the MACD right now from the price action we see here. So we could anticipate that this this uptrend that has begun will continue into the foreseeable future until we see some potential divergence down the road. All right, well, that is all for the MACD. I hope that helps, gives you some extra tools to work with. As is the case with, I would say, probably all of these indicators, they work really well when you can couple them together, at least with a couple Well, I said couple together with a couple, but honestly, like if you have a channel and you're looking at the MACD, or if you're looking at the RSI and the MACD, or the VWAP and the MACD, you know, something like that, where you can have a couple of ways to try to decipher what's happening. It's really hard to know what's happening in the stock market at any given time. So everyone builds hypotheses, and your hypotheses will be better if you have a couple of indicators that you can consolidate what information you're getting from both of them, and distill it down into one hypothesis. On the other hand, you know, unless you're really familiar and really skilled with several indicators and you really know what they're doing at any given time, I wouldn't get too crazy looking at 3 or 4 or 5 indicators at a time to try to figure out what's going on, especially if it's in real time, because that could probably just kind of confuse you and cause you to freeze, or just kind of like throw your hands up in the air and make a whimsical decision based on nothing. So, you know, keep that in mind as we go through a bunch of these like indicators and strategies. Try things out, see what works best for you, make some decisions, and just go with what seems to speak to you and what you seem to be able to execute on the best. That's going to be what works the best for you. All right, that is my soapbox moment. I hope you enjoyed the video. Please share, please subscribe, and I will see you in the next one.